Alani from Willie Factory here, and happy Friday! Struggling to keep profits up and costs down? Today, we'll focus on understanding your business costs and revenues so you can develop more effective pricing, revenue, and profit strategies. This is the fourth of 10 training sessions in our business finance series. Are you ready to maximize profits and boost growth?
Let's take a moment to think about where your money goes. Every expense, big or small, adds up. But how well do you truly understand these outgoing funds? Today's topic challenged us to look closer and ask, how much do you know about your money costs? So today for our content, we will talk about identifying overhead and unit costs. We will talk about knowing fixed and variable costs, and we'll talk about develop a pricing, revenue, and profit strategy. Now let's get started on identifying overhead and unit costs. What are overhead costs? Well, the definition of overhead costs is expenses not directly tied to productions, but essential for business operations. To give it like examples, we have rent, that is like the cost of occupying the physical space where the business operates. Next, we have utilities, that's essential services like electricity, water, and gas, and also internet that keeps the business running. We have staff salaries, that is the wages and salaries paid to employees who are not directly involved in the production of goods or services, as in administration staff, managers, marketing personnel. And next, for example, we have insurance premiums, that is the cost of various insurance policies that protects the business from potential risk. That would be property insurance or liability insurance. Usually for overhead costs are crucial for the infrastructures and support of a business. They are generally fixed or semi-fixed, meaning they don't fluctuate directly with the level of production. And they also managing overhead costs effectively is important for business profitability. So we understand the overhead costs. Let's talk about the unit cost. And usually what it is a cost per unit of products/services produced. And understanding the unit cost is crucial for several reasons. The first one is price decision. That's mainly like knowing the cost to produce each unit helps business set appropriate selling prices to ensure profitability. They need to cover the unit cost and ideally add a profit margin. Usually, they also do profitability analysis. That's by comparing the selling price per unit with the unit cost. Businesses can determine the profit margin they are making on each sale. And also, the importance is cost control, which is analyzing the unit cost over time that can help identify areas where production costs are increased or are higher than expected. This can prompt business to look for ways to improve efficiency and reduce expenses. The unit costs also affect with the inventory valuations. That's for business that hold inventory. Unit cost is used to determine the value of their unsold goods. Unit cost also use information is valuable for various bonus businesses decisions such as whether it takes on a new order, whether to manufacture a product in house or outsource it, or whether to invest in new equipment. Unit cost also can be used to compare the efficiency of different production processes or different time periods. Now, usually how a unit cost you calculate it is that you divided the total production cost by the number of units produced. Onto this slide, we have the unit cost formula. So you can see we have the unit cost, and that is the total production cost divided by the numbers of units. So let's break it down the component of this calculation. Usually the total of production cost that includes all of the expenses directly involved in creating the goods or services during a specific period. These costs typically include direct materials, that's the raw materials that go directly into the product, direct labor, that is the wages paid to workers directly involved in the production process, or the manufacturing overhead, that is indirect costs related to production, such as factory rent, utilities for the factory, depreciation of the manufacturing equipment, and indirect labor, that is like factory supervisors. And now for the divide by the number of units, that's produce is like a total quantity of goods manufactured or the total numbers of services delivered during the same period for which the total production costs were incurred. To give an example of a unit cost formula, let's say a bakery spends $500 on flour, sugar, labor, and other direct costs to bake 100 cakes. So we have a total of production cost would be $500. The numbers of units produced, it will be 100 cakes. If we find the unit cost, that will be $500 divided by 100 cakes. That will equal to $5 per cake, and that is the unit cost to produce one cake. So in summary, overall of a unit cost, it is a fundamental metric that represents the cost to produce one single unit of a product or service. It is calculated by dividing the total production cost by the total number of units produced and essential for informed decision making in various aspects of a business. So now let's get started about knowing fixed and variable costs. A fixed cost is expenses that remain constant regardless of production levels, that's rent or insurance. Fixed costs are those business expenses that do not change in total when the volumes of goods or services produced increase or decrease within a certain relevant range of activity and a specific time period, that's like usually a month or a year. The key aspect of fixed costs is that they remain constant. That's the total amount of these costs stay the same. They also, regardless of production level, this is a crucial differentiated from variable costs. Whether you produce a lot or little or nothing at all, in the short term, these costs will generally be the same. To calculate the fixed cost per unit, it will be fixed cost divided by the units. A fixed cost per unit, it usually represents the portion of the total fixed cost that is allocated to each individual unit of products or services produced. Fixed cost is the total amount when of all fixed expenses incurred during a specific period, and units, this refers to a total numbers of units of products or services produced during the same period. This formula usually highlights the key characteristics of fixed costs on a per unit basis. As the number of units produced increases, the fixed cost per unit decreases. Conversely, if fewer units are produced, the fixed cost per unit increases. You also want to understanding the fixed cost per unit is important for businesses when determining the total cost of production and setting appropriate selling prices. While the total fixed cost doesn't change, the per unit allocation influences profitability at different production volumes. You want to wonder why are fixed costs important? Well, there are several reasons. First one is break-even analysis, and that is understanding the fixed cost is crucial for calculating a company's break-even point and the level of production at which total revenues equal total costs. Another thing is pricing strategy. That's a fixed cost needs to be covered by the revenue generated from sales. Businesses consider their fixed costs when setting prices. Another thing is scalability, and as a high fixed cost can create a barrier to entry for new businesses. However, Once a business with high fixed costs reaches a certain production volume, increased productions can lead to significant decreases in the fixed cost per unit, potentially boosting profitability. And last would be financial planning. That is knowing the fixed cost obligation helps businesses plan their cash flow and ensures they have sufficient funds to cover these expenses regardless of sales fluctuations. Let's give a few examples of fixed costs. The first one we have is rent or mortgages payment. To give explanation for rent, if a business leases its premises, like office, stores, factory, etc., the rent payment is typically a fixed amount agreed upon in the lease contract. This amount remains the same each month, regardless of how much the business produces or sells. As for the mortgage payments, if the business owns its property and has a mortgage, the principal and interest payments are usually fixed for the duration of the loan, especially with fixed rate mortgages. This cost remains consistent regardless of the business output. So why is it a fixed cost? Is the obligation to pay rent or the mortgage payment exists whether the business has a high production volume, a low production volume, or even temporarily shuts down, though there might be exceptions in extreme circumstances or specific lease agreements. The second example we have is insurance premiums, and it's a business needs various type insurance to protect themselves from risks, as in property damage, liability, business interruptions. Well, they pay premiums for these policies usually on a monthly, quarterly, or annual basis. Depends on your insurance. And why it's a fixed cost? The cost of insurance premiums is generally fixed for the policy period. Whether the business produces a lot or a little, the premium amount remains the same. The level of insurance coverage is determined by factors other than the current production volume. Our third example we have is salaries of payment staff, and it's a business have employees who are on a fixed salary, meaning they are paid a set amount per pay period, like monthly, regardless of the company's production or sales levels during that period. These are typically administrative staff, managers, and other employees not directly tied to the numbers of units produced. And why is it fixed cost? And that's the obligation to pay these salaries remain constant, even if production fluctuates. While a business might adjust staffing levels in the long term due to sustained changes in demand, salaries of permanent staff are generally considered a fixed cost in the short to medium term. And lastly, we have is depreciation of assets. And that depreciation is the accounting method used to allocate the cost of a tangible assets like machinery, equipment, or buildings over its useful life. It represents the gradual wear and tear, obsolescence, or decline in value of these assets, while the actual cash outflows of the assets occurred at the time of purchase. Depreciation is recognized as an expense over time. And why is it a fixed cost? Is that depreciation expense is often calculated using methods like the straight line method that allocates a fixed amount of expense each period, regardless of how much the asset is used in that period's production. The decline in value happens over time, not directly tied to the current level of output. So, in summary, these four examples usually illustrate common types of fixed costs that a business typically incurs on a regular basis and whose total amount remains relatively constant regardless of the business production volume in the short term. Understanding these fixed cost is crucial for the business to determine their break-even point, setting pricing strategies, and manage their overall financial performance. So, what are variable costs? That is expenses that fluctuate based on production levels, as in raw materials or labor. The formula for total variable cost would be quantity of output times the variable cost per unit of output. The total variable cost is the total amount of variable expenses incurred at a specific level of production, while the quantity of output is the number of units of goods or service produced, and the variable cost per unit of output is the cost of variable resources required to produce one unit of the product or service. Let's give a variable cost formula example. Let's say a bakery makes cookies. The cost of ingredient, flour, sugar, chocolate chips per cookie is 50 cents. This is the variable cost per unit. If the bakery produces 1,000 cookies, the quantity of the output would be 1,000 cookies, and the variable cost per unit of output would be 50 cents per cookie. To find the total of variable cost, you would do 1,000 cookies times 50 cents per cookie. It will make $500. If the bakery increases the production to 2,000 cookies, the total variable cost of ingredients would increase to $1,000. Variable costs are expenses that change directly with the level of production. The total variable cost increases or decreases proportionally with the numbers of units produced. While the variable cost per unit typically remains constant, understanding variable costs is crucial for cost accounting, probability analysis, and making informed business decisions. Now, let's talk about the few examples of variable costs. For our first example of variable cost would be raw materials or inventory. To give an explanation, for raw materials, for a manufacturing company, raw materials are the basic inputs used to create the finished products. Let's say wood for furniture, fabrics for clothing, ingredients for food, that type of stuff. As for the inventory in this context, for a resale sellers or retailers, the cost of goods sold, the inventory they purchase to resell, is a variable cost. And why is it part of variable cost? Is that the more of a company produces or sells, the more raw materials or inventories it will need to purchase. The cost of these items directly fluctuates with the level of production or sales. If production or sales are zero, the cost of raw materials or inventory use is also typically zero. The second example is direct labor cost. And direct labor refers to the wages paid to employees who are directly involved in the manufacturing of a product or the delivery of a service. This often includes factory workers, assembly line staff, or service technicians whose hours are directly tied to the amount of work done. And why is it part of variable cost is that typically as a company produces more goods or provides more services, it needed more direct labor hours. This leads to an increase in total direct labor costs. Conversely, if production decreases, the need of direct labor and its associated costs will likely decrease as well. Our third example, packaging and shipping costs. To explain this, these costs are directly associated with preparing and transporting products to customers. And that includes, like, for packaging costs, will be the cost of boxes, wrapping materials, labels, etc. Anything used to package each unit of product. For shipping costs, that includes expenses for transportation, flight, or delivery service. And why it's part of it is that the more units of a company sells or ships, the higher its total packaging and shipping costs will be. each unit sold typically requires packaging, and the total shipping expenses depends on the number of shipments and their destinations. And last but not least would be sales commissions, and that's sales commissions are form of compensation paid to sales staff based on the amount of sales they generate. It's usually a percentage of the revenue from each sale. And why it's a part of variable cost is that sales commissions are directly tied to the volume of sales. If more products or services are sold, the total amount of sales commissions paid will increase. If the sales are low, the commission expenses will be also low. This, this cost fluctuates directly with the revenues generated. So in summary, these four examples visually represent costs that change the direct proportion to the level of a company's activity, primarily its production or sales volume. Understanding variable costs is essential for business to analyze their cost structure, determine profitability at different levels of output, and make informed decisions by pricing and production. So here we have an example of a spreadsheet for calculating COGS and manufacturing overhead. To find the cost of goods sold, you want a total sales minus gross profit. Let's first look for the total sales, and that would be $300,000. As for our gross profit, we have is $120,000. If we calculate $300,000 minus $120,000, you will get the cost of goods sold would be $180,000. How do you calculate manufacturing overhead? Well, that is the cost of goods sold minus the cost of raw materials minus direct labor costs. First, let's find the cost of goods sold, and that will be $180,000. Now, let's look for the number for cost of raw materials, and that will be $80,000. And now we have the direct labor cost, and that will be $50,000. Now we know the numbers, let's calculate it. Now we have number $180,000 minus $80,000 and minus $50,000, and that will be your manufacturing overhead to be $50,000. Let's talk about develop a pricing, revenue, and profit strategy. Let's start off with develop a pricing strategy. So what is developing a pricing strategy? Well, what it is that you want to consider both cost and market demand. Prices should cover both variable and fixed costs while allowing for a reasonable profit margin. And having a pricing strategy can be very based on market positioning, competition, and target audience. There are key considerations of developing a pricing strategy. The first key consideration of developing a pricing strategy would be cost coverage, and that's prices should cover both variable and fixed costs to ensure profitability. To give more detail, this is a fundamental principle of pricing. To be sustainable, your revenue from sales must exceed the total cost incurred in producing and selling your products or service. For the variable costs, these are the costs that change directly with the level of production, as in raw materials, direct labor, and packaging. Each unit sold contributes to covering these costs. As for fixed costs, these are the costs that remain relatively constant regardless of production level. As in rent, insurance, sales, you need to sell enough units to cover these total fixed costs. As for the profitability, setting prices above the total cost per unit generates profit. The margin by which your price exceeds your cost determines your profitability. As an implication of pricing, you need a clear understanding of your cost structure to set a price floor below which you will incur losses. The next key consideration you should know would be market demand, as in pricing should align with customers' willingness to pay and competitive landscape. To give further detail, the market plays a crucial role in determining what prices are feasible. This involves considering customers' willingness to pay, as what are your target customers willing and able to pay for your type of products or services. This is influenced by their needs, budget, and perceived value. Another thing we consider would be competitive landscape. That's the number and strength of your competitors. Their pricing strategies and their market shares can significantly impact your pricing options. A highly competitive market might limit your ability to change premium prices. Another thing would be price elasticity of demand. That's how sensitive is customers' demand to change in price. For some products, a small price increase can lead to a significant drop in demand, while for others, demand might be less sensitive. And another thing would be to evolve would be market trends and condition. That's factors like economic conditions, seasonally and evolving customers' preferences can influence pricing decisions. For the implication of pricing, you need to find a price point that balances profitability with attracting significant customers demand in the context of the competitive market. And our last key consideration would be value proposition, and that reflect the value offered by your products or services compared to competitors. As in, your pricing should be in line with the value your customers perceives they are receiving. This involves understanding the benefits and features. That's what unique advantages do your products or services offer? How do they solve customers' problems or fulfill their needs? They also need to understand the quantity and differentiations. So, how does your offering compare to competitors in terms of quantity, features, customer service, brand reputation, and other differentiating factors? Another thing is that perceived value. That's ultimately is the customer's prescription of value that influences their willingness to pay. A higher perceived value can justify a premium price. And last would be competitive benchmarking. That's analyze the pricing of your direct and indirect competitors. That's how does your value proposition stacked up against theirs at different price points. The implication for pricing, you can potentially charge a premium if your value proposition is significantly stronger than competitors. Conversely, if your offering is similar, you might need to price competitively. So we know the consideration. Now let's start with the strategies of developing a pricing strategy. When it comes to strategies, you want to think about cost plus pricing. That's add a markup to the cost of production. When to use is when costs are stable and predictable in the industries with less price sensitivity or when bidding on projects with clear cost estimation. How to implement is that you want to calculate your total unit cost and add a desired profit margin. That's like markup percentage. The markup should be sufficient to cover overhead and generate profit. Next, we have value-based pricing. That's price based on the perceived value of the product/service. And when you use is when you offer a unique product or service with a significant benefit that customers highly value. When you have a strong brand or when you cater to a niche market willing to pay a premium. And how to implement is that you want to focus on understanding the economic and emotional value you deliver to customers. Price your offering based on this perceived value, which may be higher than your cost or competitor prices. Effective communication of value is crucial. And next we have is competitive pricing. That's pricing in line with or below competitors' prices. And when to use is in highly competitive markets with many similar offerings, when price sensitivity is high, or when trying to gain market share. And how you implement is that monitor competitors' prices closely, and you have to decide whether to price at the market average, slightly above, that if you're offering a perceived advantage, or below, that's to attract price cautious customers. So you want to be cautious of price wars. And last we have is dynamic pricing, that's adjusting prices in real time. And when to use it is in industries with fluctuating demand, perishable goods, or when you have across to real-time data on market conditions and customers' behavior, that's e-commerce, travel, and hospitality. And how to use is utilize technology and algorithms to adjust prices in real time based on factors like demand, supplies, competitors' pricing, and customers' characteristics. You want to ensure transparency and avoid alienating customers. Here are some pricing goals that you need to know. The first one is profit maximization. That's achieving highest possible profit margin while remaining competitive. And the primary object here is to generate the greatest possible profit for each sale. This doesn't necessarily mean having the highest price in the market, as that could deter customers and reduce overall sales volume. Instead, it involves finding the optimal price point that balances a healthy profit margin with a competitive market position. Second, we have is market penetration, that's setting lower prices to enter new markets or gain market share. And that's the primary object here is to rapidly gain significant shares of a new or existing market. This is typically achieved by setting lower prices than competitors, often even below cost in the short term, to attract a new large customer base quickly. And third, we have is price stability. That's maintain consistent pricing to build customer trust and loyalty. The primary object here is to avoid frequent or drastic price changes. Consistent pricing can foster trust and predictability for customers, leading to stronger relationships and loyalty. It can also simplify budgeting and purchasing decisions for both the business and its customers. Now let's talk about develop a revenue strategy. For this slide, let's talk about develop a revenue strategy. Now here are three examples. The first one we have is focused on increasing revenue. And that is initial phase involves setting clear goals and identifying opportunities for revenue growth. It requires a strategic overview of your business and the market. Key activities in this phase might include setting revenue targets, analyzing current revenue streams, identifying growth opportunities, understanding market trends, and defining your value proposition. And we have is implement pricing strategies. That's once you have a focus on increasing revenues and understand your market, this phase involves selecting and implementing specific pricing strategies to achieve your revenue goals. Key activities in this phase might include selecting appropriate pricing strategies, setting specific prices, developing pricing tactics, communicating pricing to customers, and training sales teams. And last, we have review and adjust pricing and sales strategy. This is like a crucial final phase involves continuously monitoring the performance of your implemented pricing and sales strategies and making necessary adjustments based on results and changes in the market. The key activities in this phase might include tracking key performances indicators, or KPIs for short. We have analyzing sales data. You want to gather customers' feedback. You want to monitor competitors' actions, evaluating margin conditions. You also want to identify areas for improvement and making necessary adjustments.
So after finishing the increased revenue business, let's talk about maximizing your revenue. There are three things that you should know. The first one is increased sales volume. That's implement marketing strategies to attract more customers and increase transaction frequency. Next, we have increased average transaction value. That's encourage customers to spend more per transaction through pricing strategies. And last, we have increased frequency of transactions. You want to encourage repeat business through loyalty programs. Now let's look for examples of a pricing strategies. So for our pricing strategy, the first one we have is upselling, and that is a sales technique where you pursue a customer who is considering a purchase to buy a more expensive or upgraded version of a product or service they initially intended to buy. The goal is to increase the value of the sale. For instance, a customer wants to buy a standard laptop is shown a more powerful model with faster processor, more RAM, and a larger hard drive. Another would be upgrade a new, better smartphone. Or like an employee asks, would you like a supersize your fries and a drink for just $1 more? Next, we have is cross-selling, and that's a sales technique where you recommend related or complementary products or service to a customer who is about to make a purchase or has already made a purchase. The goal is to sell additional items that enhance the customer's experience or fulfill related needs. For instance, when a customer added a smartphone to their online shopping cart, they also show recommendations for phone cases, screen protectors, and Bluetooth headphones. Another would be after a customer orders a burger and fries, the employee asks, would you like to add a drink or dessert? Another would be a customer is buying a dress, is suggesting a matching scarf, handbag, or a pair of shoes. Next, we have is bundling, and that's a pricing strategy where several products or services are offered together as a package deal at a price that is lower than the total price would they cost if purchased separately. This can increase the perceived value for the customer and encourage them to buy more. For instance, a meal deal with the burgers, fries, and a drink offered together for $5. Another example, let's say combining flights, hotel stays, and car rentals for a discounted price. There's also software suites, as in Microsoft Office, includes Word, Excel, PowerPoint, and others that bundle together at a single price. And last we have is subscription models, and that's a pricing strategy where customers pay a recurring fee, typically monthly or annually, to gain access to a product or service for a specific period. This provides a predictable revenue stream for the business and ongoing value for the customers. For example, streaming services as in Netflix for movies and TV shows, Spotify Premium for music, and Disney Plus. Another thing we have is software as a service example, as in Microsoft 365, membership programs that's gym membership, Costco's, or Amazon Prime membership. For these four pricing strategies, upselling, cross-selling, bundling, and subscription models are common techniques used by business to optimize their revenue generation and cater to different customer needs and preferences. They can often be used in combination to create a more comprehensive and effective pricing approach. So we know the pricing strategies. Let's talk about customer focus and improvement. Now, to talk about customer focus, you want to tailor offerings and pricing strategies to customers. You also want to provide exceptional customer service to enhance satisfaction and encourage repeat business. If you want to continue the improvement of your business, you want to regularly analyze sales data and customers' feedback to identify opportunities for revenue growth. And you want to experiment pricing and promotion strategies to optimize revenue generation while maintaining customer value perception. So let's now talk about the develop a profit strategy. Now, usually to develop a profit strategy, you want to optimize cost efficiency and revenue generation. You also want to identify areas for cost reduction, and you want to continually analyze financial performances metrics to ensure profitability goals are met. Now, let's talk about the cost optimization, which can help you with your develop a profit strategy. Now, let's talk about the cycle of cost optimization. The first we have is identify cost reduction opportunities. And this is like initial step. It involves a thorough analysis of all areas of the business to pinpoint where costs can be reduced without negatively impact quantity, customer satisfaction, or core operation. Well, this might involve reviewing expenses report, benchmarking, and that's like comparing your cost against industry average and best-in-class competitors. You also want to process mapping and visually outlining your business process to identify efficiencies and areas of waste. You want to talk about the technology assessment. You want to do waste analysis, and you want to have employees' feedback. Now, here we have improved operational efficiency, and that's once cost reduction opportunities were identified. This step focuses on implementing changes to streamline process, eliminate waste, and make operations more efficient. And that could involve process optimization, automation, lean principles, technology upgrades, training and skill development, and energy efficiency initiatives. Now, here we have negotiate with suppliers, and that this step focuses on leveraging your purchasing power and market knowledge to secure better terms and pricing from suppliers. This might involve volume discounts, long-term contracts, exploit alternative suppliers, consolidating purchases, value engineering, and payment terms negotiation. The dashed arrows illustrate that cost optimization is not a one-time event, but a continuous cycle. Successfully negotiating with suppliers or improving operational efficiencies can reveal new areas where costs can be further reduced, leading back to the identify cost reduction opportunity step. This ongoing process ensures that the business is constantly striving for greater efficiencies and lower expenses. In summary short, this image highlights a proactive and iterative approach to managing and reducing costs within a business by systematically identifying opportunities, implementing efficiency improvements, and strategically negotiating with suppliers. A business can achieve significant and sustainable cost optimization, ultimately contributing to increased profitability and a stronger bottom line. When it comes to revenue maximization, you want to have a pricing optimization, and that's continuously review and adjust pricing strategies to maximize revenue while remaining competitive. You also want to have expand market reach, that's exploring new markets or customer segments to increase sales potential. And you want to enhance products or service offerings. That's innovate, and you want to improve products or services to increase perceived value and attract more customers. This image outlines the three crucial components of financial management for a business. Let's dive into the details of each. The first one we have is monitor key performance indicators, or KPIs for short, and that's a regularly monitoring relevant financial KPIs is essential for understanding the financial health and performance of the business. These indicators provide insights into profitability, efficiency, and overall financial stability. For specific KPIs mentioned would be gross profit margin, and that this measures the profitability of a company core operations by calculating the revenue remaining after deducting the cost of goods sold. A higher gross profit margin indicates greater efficiencies in producing or acquiring goods or sales. Another thing would be net profit margin, that this is the percentage of revenue remaining after deducting all operating expenses, interest, taxes, and other costs. It represents the overall profitability of a business. And we have return on investment, or ROI for short. This measures the profitability of the investment by comparing the net profit generated to the cost of the investment. It helps assess the efficiency and effectiveness of capital allocation. And what's the importance of monitoring KPIs would be performance tracking, identifying trends, informed decision making, early warning signs, and investor confidence. Next, we have the cash flow management, and that involves monitoring and controlling the movement of cash both into and out of the business. A positive cash flow, more cash coming in than going out, is crucial for meeting short-term obligations, investing in growth, and ensuring the survival of the business. The key action for effective cash flow management would be optimizing payment terms. That's you want to negotiate favorable payment terms with suppliers while encouraging customers to pay promptly. You want to have managed inventory levels that's maintaining optimal inventory levels to avoid tying up excessive cash in unsold goods while ensuring sufficient stock to meet demand. And you want to ensure timely invoicing and collection, that's invoice customers promptly and implement efficient process for collecting payments to minimize delays in receiving cash. For the importance of cash flow management, you want to meet obligations, that you want to ensure the business has a long enough cash to pay the bills. You also want to have funding operations, investment opportunities, financial stability, and negotiating power. Now, on to the risk management. That involves identifying potential risks that could negatively impact the financial health of the business and implementing strategies to mitigate or minimize their impact. Now, the types of risk would be mentioned would be market volatility, change in regulations, and unexpected expenses. For the importance of risk management, you want to protect your assets, minimizing losses. You want to ensure business continually improving decision making and stakeholders' confidence. To give it a summary, this image effectively highlights three crucial pillars of sound financial management: constantly monitoring financial health performance through KPIs, actively managing cash flows to ensure liquidity, and proactively identifying and mitigating potential financial risk. By focusing on these areas, businesses can improve their financial health, making informed decisions, and enhance their long-term sustainability and growth prospects. This image, we have an outline of key strategies for achieving long-term sustainability in a business. Now, for the first one we have is invest in research and development, and that's allocate resources to R&D to stay competitive and drive future growth, and that this emphasizes the critical role of innovation in long-term survival and success. By investing in research and development, business can develop a new product and service, improve existing offerings, explore new technologies. You want to stay ahead of competition and drive future growth. For the build resilience, you want to develop contingency plans to withstand unforeseen challenges, and that this acts as a core outcome of the other strategies and a necessary condition for long-term sustainability. Business resilience is the ability to withstand and recover from disruptions, challenges, and unforeseen events. And how you achieve is that you want to develop contingency plan to withstand unforeseen challenges, and that this involves proactive planning for potential risks such as economic downturns, supply chain disruptions, natural disasters, or changes in regulation. Contingency plans might include backup suppliers, financial reserves, or alternative operational strategies. Another thing you want to achieve is encourage innovation and learning to ensure growth and adaptation to market conditions. That's a culture of innovation and continuous learning allows the business to be flexible and adapt to changing customer preference, technological advancement, and competitive pressures. This adaptability is crucial for long-term survival. Now, for the continuous improvement, you want to encourage innovation and learning to ensure growth and adaptation to market conditions. And as a long-term sustainability requires a commitment to ongoing improvement in all aspects of the business, and that includes operational efficiencies, products and service quantities, customer satisfaction, and employee development. As you can see, the arrows in this image suggest a cyclical relationship. For overall summary, this image emphasizes that long-term sustainability is not a passive state, but an active pursuit. It requires a strategic focus on innovation through R&D, the proactive development of resilience to face challenges, and continuous commitment to improvement across all aspects of the business. By embracing these principles, organizations can position themselves for sustained success in the long run.
We have covered a lot of valuable topics in this session on understanding your business costs and revenues, including fixed and variable costs and pricing, revenue, and profit strategies. Now, I will introduce you to a useful tool to identify how additional funds, such as from a loan, can be evaluated before you apply for a loan. As a business owner, you want the best possible use of any funds, whether from a loan, equity investment, or possible grant, to gain the greatest amount of profit after accounting for fixed costs, variable costs, projected new revenue, and required loan repayment. This spreadsheet is called Debt Capacity Analysis. That's ability to repay loans from additional revenues minus expenses. It provides vital information you should prepare to evaluate how useful a loan will be for your business. You can also modify this spreadsheet to substitute an equity investment with a dividend repayment schedule instead of a loan and interest cost. This is where an investor may provide you with funds but wants a revenue stream in return for the investment. In the first page of the spreadsheet, you input the amount of loan desired, the interest rate, and the term of the loan, which is the number of months that the loan is repaid over time. Next, input the additional revenues you realistically expect to earn from use of the loan proceeds, such as for new equipment, facility improvement, technology license, or other revenues generated purposes. Then input the additional fixed and variable costs you reasonably expect to incur related to this new investment. This may be additional space costs, increased insurance fees, greater supply costs, and other added expenses. This information then provides what is called EBITDA, that's earning before interest, taxes, depreciation, and amortization. You will find the use of EBITDA in many corporate finance reports. It gives cash flow earnings that are available before making any loan repayment. Now comes an important part of this chart, identifying how much of your increased cash flow you want to have available for loan repayment. The incubator recommends in most cases that the business does not reserve more than 50% of new cash flow for banks or loan payments. Why? Because we believe that it's more important for you to be working more for yourself and your business than working for a bank or loan provider. Just think, after obligating yourself to a loan, shouldn't you be getting at least half the new returns from all your work? Too often, business owners find themselves in situations in which they are working harder just to break even or gain only marginal benefits from loan obligations. But there is a way to arrange loan payments to the benefits of the business by 1. Looking for loans that carry lower interest rates, in case 4% loans, and 2. By spreading out the life of loan terms. In the chart, 3 different loan terms are listed at 12, 18, and 24 months. Note that when you use this spreadsheet, you can change the interest rate and loan terms. After doing this, the spreadsheet will automatically calculate the new monthly required debt payment. This provides you with 3 options and 3 different monthly loan payments, depending on the interest rate and loan term. See that in the first loan example with a 12-month term, debt payment are over $2,000 monthly. This is over half the expected increased cash flow of $3,450 a month. That amounts to 57% of your new positive cash flow. At the far right column of this loan, the chart suggests you should change your strategy to stay below 50% of new cash flow. Note that for both the 18-month and 24-month term loans, repayments required is 38% and 29% of increased cash flow. So either meets the test of paying the loan provider less than half the amount of funds available. And by the way, good banks, credit unions, and other loan makers should be pleased you are making this analysis. They realize you are making good use of loan funds, are most likely to repay loan obligations, making your business a better creditor for future and possibly larger loans. Page 2 of the debt capacity analysis is also useful to you, your business accountant, and any investors. It highlights the annual amount of combined principal and interest payments. While loans can be helpful to growing an enterprise, you don't want to have too great a burden of debt, especially when you pledge collateral or personal guarantees for repayment of a loan. Again, you can adjust the amount on page 1 of the debt capacity analysis, and the chart will provide updated amounts for related expenses and revenue categories. And you do not have to restrict yourself to the incubator's 50% rule of working more for yourself than for the lender. But that is our preferred strategy for companies to grow both revenues and profits.
So that's it for this training session. Thank you for watching, and please subscribe to us here for more videos on how to launch and grow your business. You can also find us on LinkedIn, Facebook, and Instagram. This series is made possible with the grants from the Washington State Micro Enterprise Association.